Yeah, we are good to go.
Thank you. Thank you, Anjali. So very good morning, good afternoon, and good evening to everybody joining us on this webinar on the topic of recent tax assessment related issues. My name is Himanshu Parekh. I lead the tax practice for KPMG in India as far as the Western region is concerned. On this webinar, I am joined by three of my partners. I'd like to introduce first to you Hasnain Shroff, who is a senior transfer pricing partner with us. Hasnain leads the transfer pricing practice for KPMG in the Western region. And along with Hasnain, we have two corporate and international tax partners, Rishi Kapadia and Manoj Kumar, also joining us on this webinar. In the last couple of months, we've had two rounds of assessments as far as corporates are concerned. On the transfer pricing front, we witnessed two assessments for assessment year 2021 and assessment year 21-22. And on the direct tax front, we witnessed assessments for AY 2021. And what we realized in the course of our practical experiences in dealing with these assessments is that several new and interesting issues came across our way in the course of these assessments. And we thought it fit to discuss and bring it to your notice. What are some of these new issues and interesting issues? What are some of the emerging trends as far as tax assessments or tax audits in India are concerned, both in terms of direct taxes as well as transfer pricing? With that background, let's move on to the next slide. So in terms of what we are proposing to cover in today's webinar is to first provide you an overview of some of the recent interesting trends as far as international tax assessments are concerned. We'll then touch upon some of the interesting issues that have come up in the context of domestic tax. We'll then move to the transfer pricing segment and dwell upon some of the recent interesting transfer pricing controversies and the key takeaways thereafter from today's webinar. So moving on further, next slide, please. If we look at some of the recent trends that we've witnessed in these recent rounds of assessment, what we've realized is that the focus of the tax administration now is not merely to focus on monetary threshold or the quantum issue in a quantum involved in a particular issue, but the focus is rather now more in terms of risk-based parameters. The focus is more in terms of using analytics and technology tools to ascertain high-risk cases from a tax perspective, which are then picked up by the tax authorities and deeply or thoroughly investigated upon. And what aids the tax authorities in this exercise is the exchange of information which happens now on an instantaneous basis between the income tax department as well as the GST department. What we've also realized is that there's a marked focus on the intensity and quality of assessments. And what I mean by that is the kind of queries which we are receiving from the tax authorities. The queries are very, very pointed queries. The tax authorities do a thorough job, a thorough homework of all the issues involved in an assessment and raise pointed questions. Thereby, the intensity of audits has increased considerably. And at the same time, the quality of the assessment orders, especially as far as international tax assessments are concerned, we've seen a marked improvement in the quality of assessment orders. In one of the cases, which we'll discuss in the course of the webinar, the tax authorities have not only relied upon the OECD commentary and judicial precedents in India, but they've also done significant research and relied upon international jurisprudence, including foreign case laws, to strengthen their case. So this is the extent of the work or research being done by the tax administration while passing assessment orders now. One other experience that we've had is in the case of foreign taxpayers, wherever they have been claiming any tax treaty benefits, there's a marked focus in terms of ascertaining the substance of the foreign entity to be eligible for tax treaty benefits. And wherever it receives income by way of dividend, interest, royalty, FTS, and in few cases, even income by way of capital gains, the tax authorities do seek to examine whether the recipient of the income is the beneficial owner of the income or not, so as to be entitled to the tax treaty benefits. So with this, macro overview, let's move on to discuss some of the specific experiences that we've had in this round of assessment. Yeah, can we move to the next slide, please? So the first case that we would like to discuss with you in today's webinar is a very interesting issue that we've encountered in the recent round of assessment in the context of an e-commerce platform, a foreign company which has an e-commerce platform which facilitates transactions between customers on that platform, who interact on that platform and enter into transactions. And we've encountered some very, very interesting issues there, both on the front of establishment of a permanent establishment in India and on the aspect of capital gains arising from transfer of some intangible assets. And to explain this a little better, I'm going to invite Rishi to take us through this particular experience that we've had on this case. Rishi, would you like to please step in?
Yeah, thank you, Himanshu. A very good evening to all the participants, and well, I think I can only say that when we're looking at e-commerce platform, and COVID was kind of was a game changer for all our lives, and we embraced while e-commerce platforms were very much part even pre-COVID, but post-COVID, I think all and everyone kind of embraced technology, and the usage of e-commerce platform almost doubled or quadrupled as we see it. So yes, there has been a complete shift in the way we as consumers consume things, or how we use these platforms for consuming goods and services. And what we are seeing today is actually the reaction of the government on how do they plan to really tax this, and how the government is saying that they look at such platforms. I think an e-commerce platform, the business model is pretty simple. You have a foreign company which runs an app, and they have their set of customers which are registered on that app. The foreign company actually earns its revenue from the usage of the app, and that's basically the transactions that get closed on the app between potential users and customers. So that's a very normal, a very simplistic model of the app. So typically what happens is, in our case, is that we also had an Indian company, of which was a group company of the foreign entity. This group company was helping the foreign entity with certain support services, helping with certain background checks on customers who are getting onboarded onto the app. And even when there was when onboarding was completed, there were customer contracts entered into between the foreign company, and these were all typical digital contracts between a customer and the app company. The foreign company, as I said, would earn revenue from the customers based on the percentage of a sale transaction that would be concluded on the platform. As you can imagine, that these platforms, in order to grow, have to incur a significant amount of cash burn. So that had resulted in significant losses in its operation out here. And also there was a transaction specifically in relation to sale of certain intangibles by the foreign company to the Indian company. Now, this is a broad factual matrix, and we'll just jump into the issues that came up while we underwent the assessment before the tax authorities. Can some move to the next slide, please? Well, there was, as I think Himanshu rightly said, that this was probably one of the we're seeing the intensity of the audit by the tax office is really has really changed. We see a lot of incisive questioning happening, a lot of information and data being requested. This case was no different. There was an intense scrutiny of facts, documentation. And in a nutshell, the most important findings that came out in the assessment was to say that that the foreign company, while the app was all outside India, the customers' contracts were all outside India. The foreign company actually had a business connection in India, and that's simply because there are customers, users, that are based in India. So therefore, the foreign company is doing business in India, and therefore there is a business connection. They also went on to say that this business connection, apart from a general business connection, there is also a dependent agent fee. That, as we have a definition of dependent agent fee under the Act. So the tax authorities also alleged that there is a dependent agent fee. This was based on their analysis under the tax treaty. When it came to the tax treaty, the tax authorities came to a conclusion that there is a dependent agent fee. Some of the main parameters on basis which the tax authorities came to this conclusion was to say that the Indian company was undertaking significant marketing and promotion activities, which cannot be said as mere support activities. The background check and the verification service that the Indian entity is providing to the foreign entity was a significant function. And that significant function is an implied authority towards conclusion of contracts. And in our case, we also saw the tax authorities actually have a reach out to the customer base of the foreign entity and inquire from them on the role of the Indian entity versus the foreign entity. And basis that, they said that the Indian company is actually playing an active role in marketing the product, in onboarding a customer and closing a contract with the customer. So therefore, the Indian entity is playing a much active role versus the foreign company, which is basically playing a passive role and probably just accepting some contracts digitally. So those were some key findings that we saw in the assessment. We, in a first of a kind, we saw the tax office actually refer to a lot of international precedents on dependent agent permanent establishments. While we've seen there are a plethora of judgments even in the Indian context, but we've seen the tax office move a step ahead and actually do research and come up with cases in the international context also, which have held dependent agent permanent establishments in certain situations. So that was the main finding that we saw on dependent agent P. Another interesting element was the transaction involving the sale of intangibles between the foreign company and the Indian company. This sale proceeds on the sale of intangibles. The tax office actually tried to tax this as is treating that as a business income under the Act, as well as a business profit under the tax treaty. So while this was a transaction which was a sale of intangibles from overseas to India, it was held to be in the nature of a business income and taxed under the and also taxed under the tax treaty. Can we move to the next slide, please? Then coming to the question of attribution. Now, generally, what we've seen, the tax office adopts a very arbitrary approach or an ad hoc approach when it comes to profit attribution. Now, as we rightly said, that there was in our case that there were significant losses and basis a lot of information and documentation that we filed, the tax authorities accepted the position that the foreign company had in fact incurred losses, and they has accepted to attribute a certain portion of those losses as attributable towards India. So this is first in a type where we've seen the tax office accept losses position of a foreign entity. Another interesting element that we see in the findings of the tax office is the tax office raising alternate basis of taxation. As we said, that the transaction for sale of intangibles that was held to be a business profit. They also said that it is liable to capital gains tax under the Act as well as under the treaty under the capital gains article. In the context of the Act, as we may all be aware, there is a leading case law in Delhi High Court, which has held that in case of intangible assets, it is the situs of the asset which is where the owner is based that you have to look into. As long as the owner is outside India, the situs is also outside India. Now, this very case law has been distinguished by the tax office, and the tax office has come up with the argument to say that we would not look at the situs of the owner, but we would actually look at the business situs as to where the asset is being utilized, where the asset is exploited, and it is a business situs that will take precedence rather than the owner of the asset. So therefore, the tax office has actually distinguished the Delhi High Court. In coming to this conclusion, again, we saw the tax office use a lot of international precedents to distinguish its case, and we will discuss whether how do we look at such international precedents. Another interesting argument that we saw is to say that whether the intangible assets are actually a property of the alleged PE. So they said that because this is a property of the PE, that transfer of intangibles between the foreign company and the Indian company is also liable to tax under the capital gains tax article under the tax treaty. So this is an interesting case where we saw how the tax office tried to bring to alleged a permanent establishment, how tried to tax a capital gains transaction. Can you move to the next slide, please? I think in an overall basis, some key perspectives that really emerge from this is that when we talk about the concept of transfer of intangibles, we do have the Delhi High Court, which has held that it is the owner of the asset where that is situated is the situs of the asset. The tax office has relied on international precedents, but in those international precedents, while there is a concept of business situs, but in all those international precedents, the law specifically provided for a deeming provision basis which the business situs was accepted as the situs of the asset. In an Indian context, we do not have any such deeming provisions. In the absence of any such deeming provisions, we believe the Delhi High Court decision should have been still followed. If we look at the entire fact position, does that intangibles are the are the assets And can the income from the sale of such assets be really construed as business income? Because the foreign company is basically is owning the app, and it is earning some income from the operation of that app. But the transfer of intangibles is not the business of the foreign entity. So therefore, can this really be considered as business income? Interesting point would be, can one argue that intangible assets cannot really be part of a dependent agent B, and it cannot be considered a dependent agent B cannot be considered to be owning such intangible assets. The approach of the tax office that we saw in this case, where they came up to say that there were alternate findings where they said that, okay, it is even taxable as business income and is even taxable as capital gains income. Is that really permissible? Because when you undertake an assessment, you actually need to determine the taxability of the stream of income, and it cannot and there are enough precedents on that ground too, that the tax office has to come up with its analysis of what it believes is the taxation, and it cannot be left open-ended to say that it is capital gains also and business income also. So I think these are some interesting dimensions that we found in the assessment, and we really need to see how this really pans out in on a going forward basis. Himanshu, any particular comments? Yeah.
Thank you, Rishi. Some very interesting dimensions emerging from this particular case, Rishi. As you rightly said, the aspect of concurrent taxation of the same income, either under Article 7 or Article 13, something unique that we've come across in this case. The concept of the situs of an intangible dependent on the business being carried on in India, the entire concept of business situs is something new and novel out here. And on the aspect of profit attribution to P, as you may recollect, Rishi, in this case, when the show cause notice was issued to us, the revenue authorities had relied on the draft CBDT profit attribution report to allege that they would be attributing 2% of the revenues as being the profits attributable to PE. But basis the submissions filed by us, basis the India P&L account, prepared by us and shared with the tax authorities, they finally accepted that India P&L account, and they went about actually attributing loss to the P. Now that is something which is very welcome, something which you rarely encounter in terms of attribution of losses to a P. So very interesting case. Thank you, Rishi. Let's move on further to the next case. So the next case again is in the context of, the classic issue of taxability of offshore supply of goods or offshore supply of equipment. Historically, in the case of EPC contracts, we witnessed immense litigation on this aspect of taxation of offshore supply of equipment. And the key controversy being that, does this offshore supply of equipment form one part of a large contract involving an EPC contract? And therefore, should a portion of the profits arising from the offshore supply also be attributable to the PE which would arise on account of installation of that equipment in India? And we've seen widespread litigation on this topic historically. But here what we are going to present to you now is not a case involving any EPC contract. This was a classic case where an overseas parent entity supplied some goods to the Indian subsidiary to enable the Indian subsidiary to use those goods for manufacturing operations and sale of products in India. And in which context also this issue about taxation of this offshore supply came about. So I'm again going to invite Rishi to take us through this particular case.
Yeah, thanks, Himanshu. So yeah, as Himanshu rightly pointed that we also have the landmark decision in case of Ishikawa-Jima, which dealt with taxation of EPC contracts, and that said offshore supplies are not taxable, while we continue to see on and off litigation on this aspect. Now here was a typical case where it was a foreign entity which was into manufacturing of manufacture and sale of products. It had a wholly owned subsidiary out here in India, and that entity was engaged in manufacturing as well as acting as a distributor for the foreign company. The foreign company would the Indian company would import goods as and when required for distributing it into the Indian market. And between the foreign company and the Indian company, there was a set of common directors. As you can imagine, the sale of the goods would be a typical offshore supply sale where the title to the goods would pass outside India. Well, this was actually went in for an assessment before the tax office, and to our surprise, we saw a very different assessment in this context. So maybe can we move to the next slide, please? In this case, we actually saw the tax office come up with the argument to say that there is a common directors between the foreign company and the Indian company. The Indian company is a wholly owned subsidiary of the foreign company. Therefore, it is the foreign company which is actually controlling this Indian company, and therefore, we believe that the Indian company has a permanent establishment is a permanent establishment of the foreign company. Yeah. Having said that, they went ahead and actually attributed 10% of the sale transactions between the foreign company and Indian company as the profit which is attributable to the alleged PE in India. Now, in spite of there being a Supreme Court offshore supply not being taxable, enough, even you'll have the protocol to the tax treaty, which says you have to see the role played by the PE, and the PE would have played no role in connection with the offshore supply. We are seeing that the tax office trying to attribute as high as 10% of the sale value of the transaction. And again, not also an EPC contract situation, but a typical distribution arrangement where the tax office has gone ahead and taxed a portion of the offshore supply in India. So, yeah.
A very, very disturbing trend in that sense, indeed. Yes. So with that, let's move to the next slide, please. Okay, now moving to the interesting topic about taxation of software. Now, all of us would have, felt a sigh of relief when we had this decision of the Supreme Court being rendered in the case of engineering analysis, wherein the Supreme Court held that any remittance by an Indian entity to an overseas entity for acquiring a right to use software does not tantamount to royalty. And we would have felt that this decision will lay to rest the entire controversy on taxation of software. Having said which, what we realize is that this controversy continues to haunt taxpayers, especially in the case where software is provided as a service through a cloud or cases involving customization of software. We are still seeing the tendency on the part of revenue authorities not to follow the Supreme Court decision in the case of engineering analysis and yet subject these remittances to tax. To take us through these two aspects, I'm going to now invite Manoj to discuss this particular aspect. Manoj.
Sure. Thank you, Himanshu. And like you rightly said, Himanshu, while we all thought the Supreme Court would be the last word on the software matter, it doesn't seem to be so. And of course, with the review petition also being pending, the department also seems to be on a witch hunt to find different ways to keep this matter alive. So typically, the department is investigating further into certain aspects of software income that is earned by foreign companies. They are getting into details, particularly when there is software hosted on cloud and is provided as a service. And I'll just come to customized software in a bit. In case of software provided on a cloud, while the department seems to also make inquiries with third parties, they seem to be issuing 133.6. They have issued 133.6 notices in the case that we dealt with. They've gone through the website of the company on understanding various aspects, and they've come back with arguments to say that there are more elements of modifications and customizations that are being provided to customers, which therefore entail transfer of a right in the copyright or a right at least in the copyright to to the customer. Of course, while the taxpayer continues with the arguments that there is no right in the copyright that is provided, that seems to be still being disputed by the department. The other thing that the department seems to be investigating further, or at least now is an argument that the department is dwelling upon, is that the software being provided on a cloud is a platform as a service that is being provided by the seller, and therefore that entails again a right to use scientific equipment, which is covered in the definition of royalty. That's the line of argument that the department is trying to dwell upon. Of course, while the contentions from the taxpayer side are that the software is only hosted on a platform, it does not give any right in relation to the equipment to the buyer at all, and there is no element of hardware use that is entailed in relation to this to the sale of software. But the department seems to be trying to outline a different and a new argument to, in some sense, distinguish engineering analysis. We have had a few assessments that have gone against, and therefore we'll have to see how this pans out at the courts at the next level. But these seem to be the new arguments and new investigations that the department seems to be doing on. If you go to the next slide, then in case of customized software as well, now wherever the department understands that there is some level of customization carried out, they are trying to allege that this does, the Supreme Court judgment really covers standardized off-the-shelf softwares. And therefore, in case of customization request, there is a potential for the sale of software to fall within the definition of royalty itself. And that is what they're trying to allege, and they're distinguishing the Supreme Court judgment. While, of course, from the taxpayer's point of view, there is an argument still to state that these customizations may still do not entail any right in the copyright being afforded to the customer. They continue to remain a copyrighted article with no right in relation to the copyright really going to the customer, and therefore the same principle that is outlined in engineering analysis should continue and apply. There are some rowing statements also made in relation to these potentially being fees for services, while, you know, at least in the matter that we've dealt with, that has not been fully articulated by the department. But it seems that line of argument may also get detailed as we are moving forward. In both these kind of cases, we've seen some negative orders. We'll now have to take it up at the next levels. Back to you, Himanshu.
Manoj, that means that this software controversy is not likely to die anytime soon, right? We will continue to witness significant litigation on this front, unfortunately. So with that, let's move to the next topic. Next slide, please. Okay, this is again on this, issue which comes up in several cases vis-a-vis TDS or withholding tax on reimbursement of expenses being incurred by an overseas group company, and those expenses being recovered from the Indian entity, including cases where common services are provided by headquarters to all the group entities and the cost thereof being cross-charged to the relevant group entities. And the question which often comes up for consideration is that wherever there is a cross-charge of the cost of these services, whether the reimbursement towards that cross-charge, does it tend to amount to fee for technical services? Should that remittance have suffered any withholding tax on the ground that it qualifies as fees for technical services? Some of those aspects come up for consideration from time to time. I'm again going to request Manoj to share with us our recent experience on this subject matter. Manoj?
Thank you, Manju. Yeah, and like you rightly mentioned, this is again becoming a hot topic for the tax office, where income or most foreign companies are reflecting this income as amounts on which no tax liability exists in India. And it more starts from an investigation on the Indian company side, where these payments are made to the foreign company where taxes are not withheld, the examination is becoming far deeper and far more intense. They start with asking the entire, and once the examination from a 201 perspective starts on the Indian company, the tax office is now parallelly starting the assessments in the hands of the foreign company, and therefore you see the questions coming on both sides. Common questions. They now are and what we saw in the recent trend set of assessments is they went into asking details of the entire allocation pool, saying, give us details about how the expense is allocated to the Indian company. Let us know the total pool of expenses incurred at the parent level, which are the internal expenses and what are the external expenses. They're asking for details to understand all those expenses. They're asking for, supporting documents to establish, the benefit of the expenses that is flown to the Indian company, and to support the reason for the allocation into the Indian company. Of course, with details such as, mail correspondences, nature of services, write-ups, agreement copies, invoice copies, all of that is being looked for. Including the normal documentation such as TRC, 10F, NOP declarations, all of that is being sought for through the assessment proceedings. As the department is going through this, they are then examining the make available clause far more deeply, where in most cases, we taxpayers have taken the position that all administrative expenses that are remitted to the foreign company do not, where the treaty carries the make available clause, they are taking the defense that these expenses, these cross charges do not make available any technical knowledge, skill, and experience, and therefore they don't fit into the make available definition under the treaty, because of which these cross charges are not liable to tax in India. But the department is trying to understand every line item and asking, saying which of them entail training and what category of training, and with how these expenses have been examined to test them for the make available argument. In the assessment order, we have seen the department outlining adverse comments on, verifiability of the reimbursement nature of the expenses, saying, they want to have a clear idea of the expense and how is it exactly a reimbursement, and that it does not entail any profit element. And they are saying we are not able to verify unless you give us effectively all the documents of the overseas company. They are questioning the allocation of the expense to the Indian company and the basis that is being applied. And they're saying we are not able to comment on whether this allocation is correct or not. And we need to understand the entire global method to be able to comment on whether the allocation to the Indian entity is correct. The third area that they are trying to dent is to say that the administrative support services itself that are being provided by overseas companies to Indian companies, whether it's in the nature of HR, finance, and any other support function, they also effectively are making available some knowledge to the Indian company on the administrative side to be able to allow the Indian company operate. And therefore, they are saying we are of the view that the make available test is being satisfied. That's how the last round of assessments have closed. Now, at this stage, we have about between 16 to 20 tribunal rulings on administrative expenses, most in favor, a few of them against. And recently, there has been a Delhi High Court judgment, again, which has held administrative expenses not to satisfy the make available test. But of course, it doesn't seem the last word on this is out, and therefore we will see this litigation going forward.
True, very correct. Yes, Manoj, I agree with you. Let's move on to the next topic in the interest of time. Let's come to some of the observations or experiences in the context of domestic taxation. Yeah, moving on to the next topic. Now, this is the ever interesting topic about claim of tax depreciation on goodwill. As we all know, goodwill is no longer a depreciable asset ever since the amendment happened in 2020. But for the period prior to that, taxpayers have been claiming tax depreciation on goodwill. and goodwill arising both on account of a business acquisition or a slump acquisition of business, as well as goodwill arising on merger of companies. And we witnessed widespread litigation on this subject matter. But in the recent round of assessments, we've had a very, very interesting experience where basis the submissions filed by the taxpayer and making out a case as to why goodwill is a depreciable asset, especially for the period prior to the amendment, and relying on the decision of Supreme Court in the case of Smith Securities, we've come across quite a few cases where the tax authorities have accepted the contention of the taxpayers and actually allowed depreciation on goodwill in the course of the assessment. Now, this is a very, very welcome trend. In fact, if I may share, our experience on the faceless assessments this year has been pretty decent, pretty good, I would say, because in several cases, we've come across the tax department granting significant reliefs to taxpayers wherever a case has been made out by the taxpayers based on merits of the case. We have hardly encountered any cases where any frivolous adjustments would have been made by the tax department this time around. So with that, we quickly move to the next slide, please, in the interest of time. And I'm going to again invite Manoj here. And this topic comes up for consideration primarily in the context of Global Capability Centers or GCCs, which provide services to overseas group companies. And there's a tendency in such cases of the overseas group entity or the parent entity to provide some assets on a free of cost basis to the GCC to enable the GCC to provide services to the overseas group entity. And the controversy which comes up for consideration in such cases is that the asset which is provided by the overseas parent, let's say to the Indian GCC, does that result in any benefit being provided to the Indian entity? And should that benefit be subject to tax under Section 28(4) of the Act? Manoj, your thoughts on the subject matter and the recent experiences we've had thereon, please.
Sure. Thanks, Himanshu. So, yeah, this matter, like Himanshu said, has started a while back, and there is some trend on it because there are two tribunal rulings in the public domain a while back, one in the case of Hewlett-Packard Software Operations and the other one in the case of Marvell India. In both cases where the tribunal has dealt with this matter, in one of them it has held that foreign asset provided free of cost to the Indian entity is a benefit in the hands of the Indian company. And in the other case, in the case of Hewlett-Packard Software, while they said there is a benefit, they remanded the matter back to the officer to determine the quantum of benefit. Now, given this background, the officers continue to examine this aspect in the assessment proceedings. We've seen 2-3 trends. In APA proceedings also, we've seen this question that has started coming up. We've started seeing, companies offering, making suo motu adjustments in relation to FOC assets received by them in finalizing APA proceedings. And now as we go through assessment proceedings, in the last cycle, we have seen the department appreciating some facts if you're able to put on the table. Now, then that's why the last bullet on the slide says, we've had some favorable orders from the NFAC. That's important to take note. Now, where we've been able to substantiate to the department that these assets have been received by the Indian company in relation to a service arrangement, and these assets are utilized in relation to the services rendered by the Indian company to the foreign company. Let's say these are testing services and there are prototypes received for the purpose of rendering the testing services. And at the end of the testing period, these prototypes are either delivered back or they are discarded or disposed of under the instruction of the foreign company. If you're able to put documentation substantiating everything, then the department seems to be all right to accept the case and say these are free of cost equipment received, but this does not amount to a benefit to the Indian companies. So some favorable judgments, but I think the matter still seems to be sub judice, which means in all fact patterns, we shouldn't jump to a conclusion. We should know what our facts are. We should back it up with good evidence and then take an appropriate call.
Thank you, Manoj. So in the interest of time, let's quickly move to the next topic, and thereafter we'll straight move to transfer pricing. So let's skip this slide on CSR versus ATG. Let's rather move to the more important topic about reconciliations being sought by the department. So Manoj, if you can just spend a couple of minutes on this, please, providing a perspective on what has been our recent experience on this aspect, and then we straight move to transfer pricing, please.
Sure. Again, this large reconciliations seem to be the way forward. The department, given that the interface between GST and income tax is at its peak, and of course the amount of data that is being sought in the tax audit report, the department seems to be going this way. We say these 5, 6 reconciliations are the key ones: the Form 26AS RECO, the Clause 34A RECO, import data, which is given by IceGate, reconciling that with financial statements. In fact, in the import data versus the financial statements, you also bring out the FOC free of cost assets. So that also seems to be coming out as a reconciliation item, and the department is understanding that. The other area is GST data with financial statements. They're asking for these reconciliations. 40A workings, again, as a part of Clause 34A. In some sense, it gets linked to that. And purchase reconciliation, again, with the import data. That's the other area that the department is asking. Now, they are inquiring into all of this. And wherever there are gaps that are remaining unreconciled, we are having additions that are being made by the department on any of the gaps that remain unreconciled in any of these reconciliation statements, which then we'll only have to sort out at the subsequent levels with data and with substantiation. So the fear of all these additions they are all fact-based, and once made, to reverse them is very difficult without substantial facts.
I fully agree, Manoj. And just to share a practical experience in one of the cases where the tax department granted very limited time to a taxpayer to make these reconciliations, and because the taxpayer was unable to provide these reconciliations in that short time granted by the department eventually made an adjustment of 650 crore rupees. Eventually, the taxpayer filed a writ petition to the High Court, and the matter has now been restored back to the department to conduct a fresh round of assessment. But these are the kind of adjustments we witnessed in some of the cases. So with this, I think we can skip the next slide, which is on section 68, because we have a lot more interesting ground to cover on transfer pricing. So let me now invite Hasnain to take us through some of the interesting experiences on transfer pricing assessments. Hasnain, over to you.
Yeah, thank you very much, Himanshu, Rishi, Manoj. A very good evening to all the participants. Unlike corporate tax assessment, for transfer pricing, we had the benefit of 2 rounds of assessment. And you can imagine that the level of creativity and the new type of issues which have emerged in 2 rounds of assessment. So the way we will just discuss very quickly on transfer pricing experiences is, we'll first look at a couple of cases which have had some kind of a really standout kind of outcomes. And what we have done is we have covered 3 cases which are almost like loss making and or almost a neutral profit. And despite being issued show cause notices, ultimately, due to the arguments put up by the taxpayer, there was some successful outcome. And after that, we will go through some of the areas where a lot of questioning, focus, or new type of lenses have been applied by the transfer pricing officers. So this first case is a case where this is an Indian company, and it has around 4-5 overseas subsidiaries. They are engaged in providing marketing and support services and are getting remunerated on a cost plus markup basis. The Indian entity was in losses for this particular year, especially for a variety of reasons. And the Indian entity had taken the overseas entity as a tested entity because they were being paid on a cost plus markup basis. Now, very interestingly, the transfer pricing officer said this is not marketing support services, but this is management support services. It's some kind of a support coming to the Indian entity, and maybe there is some element of sale, but it is overall management support services. And he said that since there is no need benefit test which is submitted, I would identify the arm's length price as nil. And that's what he issued a show cause notice. The taxpayer thereafter, once receiving the show cause notice, actually got into full drive. And what they did is they actually went all across to showcase as to there are no marketing and sales people in India. And if 95% of the sales of this Indian entity are coming from overseas jurisdiction, and they were entering into direct contracts, and these contracts were not routed through these particular marketing arms, they were directly entering into these contracts, 95% coming from overseas entities. There is not even a single sales and a marketing employee in India. That clearly identifies that there is a need for this particular service to take off marketing support services. So obviously with this particular, and thereafter it was supported with the number of leads which were generated by these foreign entities, the number of the contracts which were signed, the number of clients which were being managed by them. With that kind of a data which was presented to the transfer pricing officer, it became absolutely difficult for him not to accept this particular proposition that this is not a marketing support activity. Can you go to the next slide, please? Yeah, can you move to the next slide? Yeah, thank you. So ultimately, it was also identified that whatever losses are being incurred are for strategic reasons, and there is nothing linked to the intra-group payment. It is more about the pricing which is being entered by the Indian entity. Ultimately, the transfer pricing officer accepted this particular thing, and because he accepted that this is a market support activity and not a management services, then there is no need for a need benefit test also. And thereafter, this particular adjustment which was proposed in the show cause notice was dropped. What is very important coming out from this particular, I would say, the case is that the way the data was presented from every aspect, the point which was raised by the officer was absolutely like, undone, I would say, in terms of every parameter, that there was nothing which the officer could say, no, that this is not a receipt of service, and this is not a required, and this is not a marketing support services. And despite there being a loss, and which is the tendency that whenever there is a loss, the transfer pricing officers would believe that the intra-group service is somewhere where there is a leakage which is happening. Yeah, can we move to the next slide, please? Yeah, this is very interesting. Another case where there was a capacity underutilization due to COVID, and how the officer went about doing this. So this is an entity which is in an aerospace industry, and they were manufacturing certain components that required some kind of adjustment, because the customers in India who are requesting some kind of an adjustment to be made to the existing product to be compliant with Bharat 6 requirement. And despite not the Bharat 6, this is some other case, but there was a requirement for a customization. Now, what happened is that in this particular year, the entity had a significant fall in their turnover. The entire industry was reeling, which we were aware about it. And the capacity underutilization adjustment was sought. This was company in losses. Previous year, they were all in profits. And this year, especially when there was a loss, the officer was not willing to. And the point which was highlighted by him was that if you are incurring losses, so would your comparables be facing those issues? So why should I give a COVID adjustment separately, or a capacity underutilization? Because that would be something running similar for all of the comparables. Now, when it came again after the show cause notice was issued, and as we know, once it is issued, every SSE just gets into the overdrive. So what happened is here, it was clearly brought out that there is absolutely no change in the pricing policy which is adopted. And whatever was the pricing which was being done pre-COVID continues to be done in this particular year. And whatever time which was being spent for each particular project, they had maintained a very detailed time study, and what time is being underutilized and not being occupied, and how the manpower is absolutely like, sitting idle. All of them was actually documented. And then ultimately, the best part which worked in their particular case was to showcase that all the comparables which were being selected, in their case, the underutilization was to the extent of 20%, whereas in their case, it was 57. Now, underutilization of 20 to 57 absolutely cannot be compared, and it had to be considered. So ultimately, looking at the facts and all the particular evidences, the officer was willing to give a partial relief. There was a partial relief which was provided, though the full relief was not given. But this was a very significant thing where, despite the show cause notice being issued and the officer saying that this is not a case where any of their instructions are given from the CBDT to consider COVID cases favorably, and all companies, including comparables, are suffering in that particular way, why should there be a single out? But however, in this particular case, they actually gave. And not only this, there was another case in where the client was in a auto industry, and something similar happened, that they, however, impacted very significantly. And in that case, they were able to bring out the reports from the industry reports to showcase that the entire industry has suffered X particular amount of underutilization, whereas in their case, it is far higher. Those industry reports were very credible, and the data coming from the assessee was far, far higher in terms of underutilization. And fortunately, they also got a similar kind of a capacity and utilization adjustment, and the relief was granted to them. Yeah, can we go to the next, third one? Yes. Now, this is a case, again, which is relating to intra-group services. There was an Indian entity which is manufacturing exhaust gas recirculation, and there was a request coming from the clients in this particular year from a lot of OEMs that they want a lot of modification and customization to this particular product. Now, the taxpayer did not have this particular capacity or the capability. So they approached their AE for the support to make these kind of changes to the product, and thereafter go back to the clients with a revised product. Now, this was a year where they had actually come down in profitability. They were in break even. But what happened is, again, when the matter came to the officer, he noticed that this year there has been a jump in the payments being made to the overseas AE, and from 5%, it has actually gone up to 8%. And due to this, his presumption was that this profitability has reduced significantly. Now, the initial way which happened is the taxpayer, like any other situation, would have submitted a TP study report adopting transactional margin method and putting comparables. And that became a very easy kind of way to target this particular client. The officer said that, no, I would not consider this particular, and he made comparables for making profitability, and I would not accept these particular kind of services to be acceptable because it is just increasing from 5% to 8%, and you are not increasing your profitability. Now, when the show cause was not issued by the officer, the first thing was to be done is to pivot this particular conversation from TNMM method to actually go into the transaction of this particular payment, which is there of the intra-group services, and focus on only two parts: whether there has been a service received and whether the pricing of that particular product or the services is correct. Now, again, in this particular case, fortunately, the taxpayer was able to collate and demonstrate that there is one-to-one request which is coming from the customer, and that is flowing back to the associate enterprise A for the purpose of remodeling the particular product. And in that particular process, whatever services are required, whether feasibility study, whether it is development or the prototype, whether it is coming back and going into the manufacturing guidance, whatever is happening, everything was being correlated well to well. And this clearly brought out that there is a clear kind of a rendition of service. And along with that, whichever clients which are being added to this particular service, the cost which was being received from the associate enterprise, that was being built into that particular project. And so it clearly demonstrated that whatever cost has come in from the overseas has actually got passed on back to the customer. So effectively, the two parts, one is the rendition of the services as well as the pricing was demonstrated. And finally, the officer accepted this particular relief, provided to the relief to the taxpayer. It was a very, very big material amount. Can we go to the next slide, please? Yes. So, okay, let's move to the next slide. So these were the three very specific cases where we saw the taxpayer in India is making losses. The transfer pricing officer is not willing to actually give a COVID adjustment, but they were willing to give special consideration basis the facts of the taxpayer. And what turns out is, even after getting a show cause notice, if the data point and the argument is well articulated and documented, there is always a hope for getting a relief back. Let's go to the next slide. Yeah. What we will now do is we will quickly just scan through some of the issues which have emerged during these particular last two rounds of assessment. The first one rotates around the marketing support service provider. As we all know, there have been a lot of issues around that. And one of the suspicion or the apprehension of the transfer pricing officer is that a lot more is being done than what is actually documented. And in a couple of cases where the officers were actually making inquiries and trying to understand, they felt that this is providing far more and that these type of entities should be categorized as entrepreneurs and should be getting commission. And most of the inferences were coming from a few of the data points, and I'll just share one of them, is where some of the employees were getting paid of this particular entity basis the sales or generated or the sales linked incentives to these particular employees. Effectively, what it meant is that there is some element of incentivization being happening to this particular entity. Maybe this entity is being paid on a cost plus markup, but when the employees are being paid linked to sale, it effectively means that the compensation coming to this entity on a cost plus markup is also linked to sales. And that's why there were issues being raised whether this entity should be getting marketing commission or it should be just getting a cost plus markup. Similarly, the other way around, there was certain limited risk distributors which were absolutely doing nothing, and they actually followed the market support service providers functional profile, except that for accounting purpose or for the trading purpose, the billing entity would be the Indian entity. And in those cases, the officers have tried to question whether this should be characterized back as a market support service provider. And in those cases, the attempt was being made that whether all the cost plus markup has to be recovered on the entire amount because the markup is higher. But in those cases, fortunately, the argument was that if the officer wants to look at these particular cases as a market support service provider, then they can't include the cost of the software. And effectively, that would nullify the attempts which are being made by the transfer pricing officer. Similarly, in case of captive service providers, we have seen that wherever there are employees whose name is getting registered for the purpose of patent registration, in those cases, the officers have tried to adopt the higher end of the margins, or they have applied the R&D filter and tried to increase the margins which are applicable to these kind of cases. We heard about the notional cost earlier in the discussion, and wherever the captive service providers are there, they have been asked in detail what type of cost which are being incurred overseas are not being booked in the Indian entities book, and those are being loaded with the markup in India. Coming to the filters, this time there was clear trend going towards applying the 10 times filter both on the higher and the lower side. And the tendency was to look at 75% foreign exchange filter. And the last point for the captive service provider was the interest that was being computed on the delayed receivables. We saw a very wide variety of approach being adopted. Certain officers were looking at beyond 30 days, they were wanted to apply impute interest on the delayed receivables. In certain cases, they were looking at whatever was coming in the contract. Beyond that, whatever is actually being delayed is being subject to delayed receivables. Can we go to the next slide? Yeah. Looking at the royalty, until a couple of years back, we had major issues on royalty. It had subsided back. But this year, again, we saw a lot of focus of the officers on the royalty payments. And critical thing to see is that were these being benchmarked on a transaction basis, or they were actually being looked upon in TNM overall entity level. With the officers were not willing, they have now got access to databases, overseas databases, and they are actually using those particular access to benchmark the royalty transaction. Clearly, the focus was there on to see whether there is a need benefit test being satisfied, whether the overseas entity is continuing to spend the money to ensure that there is the relevance of that particular IP. And every year, is there some kind of a benefit which is flowing to the Indian entity? There were clear cases which were happening, questioning was happening on cases where there is an increase in the royalty rates, and those cases have been subject, and many cases they have not allowed the royalty, whether there has been increase in the royalty rates. And more so, royalties to the third parties was considered in a different bucket, whereas royalties on sales made to group entities were being looked very, very differently. Coming on the financial transactions, you look at in certain cases where there have been sale of equity shares, we have seen in the past also that there have been DCF methodology which have been adopted. And when in the subsequent assessments, when they saw that the data which was actually available, if it was varying by 20%, then they would substitute these data of actual numbers with the numbers which were used in the valuation report, and basis that revise the valuation and make the adjustments. In certain cases, we have seen that where basis India's accounting standards being followed, certain type of loans were being reclassified as equity. And in those cases, the officers have questioned why interest should be payable on these type of, when the taxpayers themselves have reclassified these particular transactions as equity in their books of accounts basis India's accountings. Let's go to the next slide. Yeah, the important point is about the foreign entities. They have been asked to submit their own independent transfer pricing report and their separate justification. Unlike in the past for mirror transaction, there used to be an approach where the transactions of the Indian entity or the transfer pricing study, once it is accepted, the foreign entities cases were also being accepted. But here we saw in a lot of cases, officers asking for a separate justification and evaluating separately for the foreign entity. And the last point, which has always been a very broader topic of discussion, is about the intragroup services. Clearly, this was a year where we saw a lot of detailed kind of discussions happening on the need benefit test, on the rendition of services. And we discussed in the earlier case, 3 cases where how detailed kind of need benefit tests being provided help the taxpayers to sail out of even after receipt of the show cause notices. And this one particular point is that in many cases for the captives where the intragroup services were not being justified, but they were coming only on the basis of ratios, the officers have actually disallowed them. And this has not actually helped them to add into their margins. They made a separate adjustment for these particular, and it was like a double whammy to these kind of taxpayers. So this was just a very, very quick kind of a pulse and the things happening on coming from the 2 rounds of transfer pricing audits. I'll stop here and hand it over back to Manoj to summarize, and we'll be happy to take questions if any. Thank you.
Thank you, Hasnain. Yeah, I think like we've seen, the department is not keeping our life boring or keeping anybody sleeping really. They're on their toes and are ensuring we're all on our toes. So I'll keep this really short in the interest of time. The department is really maturing in their approach to the assessments, and it's important for taxpayers to also not play a catch-up game, to maybe be a step ahead, whether it means using technology tools, whether it means keeping enough backup on treaty claims, whether it means on PE kind of audits, having enough defense that is prepared, whether on transfer pricing, like we said, being conscious of the issues that are emerging and preparing for them in advance. And even if there are Supreme Court judgments, not just relying on them, but doing a proper analysis and then placing reliance on them. So that's really a summary. Thank you all for attending the webinar. We can now stop and take some questions if you all have any.
So Manoj, there is one question which I can take is, should economic adjustment be made in TP study report or should be claimed during the assessment proceedings? I would say clearly, like, as much as possible, every type of adjustment should be documented in the transfer pricing study report. It is always easy to work out any kind of economic adjustment during the year, closer to the year, but down the year, 2-3 years down the line, it's always difficult to actually contemplate as well as to go back and collate the details. And absolutely, there's no downside in claiming it in the transfer pricing study report. It just reserves all the rights.
Thanks. I see another question saying, the questions from the AO are within short period and they're not providing enough time. How do we face this? Unfortunately, that seems to be the trend in this assessment cycle. So there are two ways to approach this. One, from a taxpayer's perspective, I think we are expected to have a reasonable level of preparedness. And if that is not there, it's better to have some reasonable level of preparedness in terms of data to be able to provide data within a reasonable period of time. But of course, if we are getting notices to provide data within 2 days, 3 days, and large voluminous data, we are placing that on record that this is against the principles of natural justice and ask for extensions of time. And if we are not getting, of course, this will come to our rescue at the appellate levels, or if we use any other alternative course of remedy. That's the only way to approach this.
I think there's another question which has come. What have we seen a recent trend where non-resident entity employees visit Indian subsidiary in terms of the PE analysis? I think this is a very important question, and I think in the beginning of the Manoj, when we talked about the key takeaways, one of the important points that we said is that there is an extensive audit being conducted, especially when it comes to permanent establishments. And we have definitely seen the tax office ask specific questions in terms of if you have a subsidiary out here, let us know whether anyone from the foreign entity has been visiting the Indian subsidiary. So the tax office has been asking for this data. And the data can go back for a number of years, and it starts with asking, please let us know who has visited and what is the purpose of the visit. So this is an important information to kind of note and be prepared for.
Yeah, I think we've just not seen the orders, alleging the service fee with, the short periods of times in the treaties that they entail. But these kind of inquiries are being made. If the preemption are those kind of orders coming through still? Not this round, but given the kind of inquiries, you may see those kind of orders also coming in.
There's one more question about, have you seen TP officer asking information from overseas jurisdiction on related party transaction? If so, how will this be used by TPO? So what I understand is during the course of Indian entities audit, and let's say if you are using the foreign entity as a tested entity, how would the officer be in his authority to ask for information about the overseas entity? See, the point is that, first of all, the officer can never go out and reach out to the foreign AEs directly. He would have no authority. Even if he were to ask and write to them, the foreign entity will never respond to them. At the most, they could use the government-to-government channels, which are there for exchange of information to get some information. But normally what we have seen in the transfer pricing audits, they would ask the details of the foreign AE, their P&L account, any other details which would be required. And obviously they would be in their right to ask that data. Otherwise, how would the officer check the cost plus markup if the foreign entity is being adopted as a tested entity? And this is where, if we see that there is a cleavage of case laws on the foreign entity being adopted as a tested entity, a large majority saying that yes, you can adopt them. Mostly at the officer level, they were never accepting it. But there are 2-3 decisions where the data was not available to the of the foreign AE as well as the comparable sets. And that is where the couple of decisions have said that you cannot use the foreign entity as a tested entity. So I would suggest that it would be in our good interest that if we have adopted foreign entity as the tested entity, to provide the information about the comparables as well as the profitability of the overseas AE. Yeah.
Now, in the interest of time, then maybe we should bring this to a close. I know we've overshot.
Yeah.
Sorry, go ahead.
Yes, so I think I hope all the participants had a good kind of overview of the pulse, what has happened in both the corporate, international, and transfer pricing assessments. We thank you very much. If there are any questions, please do write to us and we will separately reach out to you all. So once again, thank you very much on behalf of all of us. Bye-bye.
Thank you. Bye-bye.
You, bye-bye.